All right, let's go ahead and get started here. Again, everyone, thank you so much for joining with us today. Today we are going to be discussing some pretty interesting topics with regard to analyzing deals and also things that you might not necessarily be super familiar with regard to how commercial real estate investments can be structured through something called preferred equity. We're very pleased to welcome on Tim Donovan with Midloch Investments. We'll get a few things out in the beginning and then turn it over to him. Again, thank you for joining with us. This is a webinar presented by Advanta IRA. My name is Alex Perny. I'm the moderator here today. If you do have any questions regarding self-directed IRAs or the particular investments that you can pursue through these types of accounts, I am always happy to help because this is very topical to what a lot of clients, are looking to invest in with their self-directed IRAs. Quick disclaimer before we get started, Advanta IRA and our employees do not provide any investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of financial investment. And before we turn it over to Tim, one quick thing that I would like to just make sure everyone is aware of is that all audio on the participant side has been muted. So if you would like to ask a question, which I encourage people to chime in and ask, because it's always great to have external resources like Tim on the line here, make sure you type those questions in. And if you would like a copy of the slides, you can either reach out to myself or Tim, and also I have attached them as a handout to this webinar presentation as well. With that said, I really want to extend my appreciation to Tim for being on with us today. It's always very nice when we have people that take time out of their busy schedules to come on and help educate our investor base on some interesting topics, and this one certainly does qualify. So with that said, Tim, I'm going to go ahead and turn it over to you. Thank you very much for being on with us today, and I'll let you go from here.
Absolutely. Well, thank you, Alex, so much for obviously having us, and thank you everybody who is here on the webinar today. I'm excited to talk to you all about this, share a little bit of insights of what we do at Midloch, and hopefully can answer any questions that you have about our process and kind of how we approach real estate investing. So with that, I will jump in, and just a quick little bit about myself. So like I mentioned, my name is Tim Donovan. I'm one of the managing directors at Midloch Investment Partners. I'll give a little bit more about kind of who we are at Midloch, but for my responsibilities day to day at Midloch, I really focus in on what I sort of say, everything on our end, from sourcing new investment opportunities to underwriting, due diligence, and ultimately asset management and disposition. So my focus is really on kind of the analysis and selection of investments, and then obviously everything that kind of comes along with once you buy a property, what do you do to run it? So my contact information is here on the slide as well as at the end. If you guys have any pointed questions about the discussion today that you're not able to get in the Q&A session, you're obviously welcome to reach out, and happy to help us to the degree I can. Just a little bit more information on Midloch Investment Partners. We're a boutique real estate investment fund manager. We focus on investments in apartments, industrial, retail, office, and other select commercial properties. We focus on what we call the small to middle market. So we say that's basically anything above what an individual might buy themselves and anything below institutional investments. So we kind of call that the $5 to $50 million range. One thing that's a little bit unique with us is we do a partnership model. So we are LP equity investors. We are partnering with local individuals throughout the country to buy and run our properties. And so in my role as managing director on our investment team, my job is really to look at hundreds and hundreds of deals a year, assess whether or not other real estate GPs models and projections make sense, and then we ultimately decide whether or not to partner with them. So my day-to-day is probably not too dissimilar than many of yours, looking at investment opportunities, and we're kind of coming in with the majority of the capital on any of these deals, and we're partnering up with local GPs. So that's just a little bit about us, and kind of just shows a little bit of kind of my role and what day-to-day looks like on that. So today we're kind of going through two main areas. I wanted to talk through a little bit of sort of the deal selection process, right? How do we approach markets? How do we approach properties? How do we approach underwriting and making sure that the deals and opportunities that we're getting presented make sense? And then how do we make sure that they're being capitalized in a way that sets the property up for success? And right in a market like we're going through now, how do we set the property up so it can go through a little bit of a turbulent market without causing too many issues. And then on the back half, wanted to talk through a little bit about preferred equity. It's something that a lot of investors are not as well versed in. It's something that was not as big part of a market as it is today. Talk a little bit about how that is different from common equity and some instances and where preferred equity makes sense to explore. And then hopefully at the end, we'll have a little bit of time to do some Q&A. So to start off a little bit, like I said, we are limited partner investors, right? We're bringing in anywhere from half to 90% of the capital that goes into any given deal. And with that, we really take sort of several different approaches of deciding where do we want to invest, what do we want to invest in. We invest all around the country, we invest across different property types. So to really sort of narrow in our focus, I like to say that we take a top-down approach, both with regards to markets as well as property types. So talking through all of this, right, on the market side of thing, we really take kind of the whole country as a whole. We really only invest within the United States, but we look at things regionally, right? Regions like the Midwest, the Sun Belt, the East Coast, the West Coast. There's a lot of different investment opportunities out there. And so we first and foremost try to have a personal and kind of corporate opinion on where we think there are good investment opportunities. So we look a lot at things like population migration trends, climates, where major employers are moving, right? Over the last several years or decades, right? There are certain markets in the Sun Belt, right, that have significant tailwinds when it comes to population growth, when it comes to companies relocating, right? And there's a lot of reasons for that, and climate has historically driven a lot of that. And then when you get within regions, you start looking at states, right? We look at political tilts, right? Whether a state leans left or leans right, and then what risks or opportunities come with both of those. We look at population growth rates, right? Maybe there are some states within the Sun Belt that are not growing as fast as others, right? And what does that mean for investment opportunities? You could dial that in a little bit further, right? We look at cities specifically, right? Within states, right? Is how much investment demand is there? I think that's something that is not necessarily talked about enough, especially over the last few years, right? How much liquidity is there in a given market, right? Just because you might invest in a deal in Dallas doesn't mean if you buy a property in an hour, or in a market 2 hours outside of Dallas, that doesn't mean that you can get the same type of pricing and the same type of liquidity. And we also look at major employers, right? Markets that have diversity of employment bases, markets that have employers that are moving into the market, things like that. Once we sort of take that approach, right, and come up with our list of regions we like, states that we like, cities that we like, we then really go one step further and start talking about submarkets, right? It's what parts of town have strong demographics, have good schools, have low crime. Those are all things that we view as influences for a property performing well. Now, I caveat all of this with, we truly believe, because real estate is a fairly local and inefficient asset class, there's opportunities to do well just about anywhere, right? We just try to position ourselves so we align with the tailwinds of the market. But at the end of the day, it's picking the right deal, paying the right price, and investing in the right property. So going a little bit further on that, right? Now that we've talked a little bit about how we approach and look at locations, we do the same thing when it comes to properties, right? There's a lot of different areas that you can invest in. The big ones, right? Multifamily, industrial, office, retail, but there's other things like self-storage, there's parking assets, there's outdoor storage, there's mobile home parks. We look at all of those and really try to align ourselves with where investor demand is, right? Where is capital flowing? That makes a really big impact, as well as the financeability, right? There may be really good opportunities in office, but it could be hard to source a loan. So we look at all of those different components when we decide what areas we like to look at, as well as property specific things, right? Vintage, how old is the property? How big is the property? How many units to the apartment building? Things like that all impact, right, what falls within our investable universe. We also look at qualities, right, in the apartment space, unit size, amenities. Again, it kind of ties back to vintage a little bit, condition. On the commercial, right, access is very large, a large impact for us, how much parking it has, what types of clear height, what type of loading. it's all of those property qualities too that we sort of set our box of what do we find interesting. And the construction side as well, right? Construction materials, what type of power it has, what type of electrical, what type of plumbing. We run into a lot of instances with older apartment buildings that, though it's a good opportunity, it was maybe built with certain type of wiring or a certain type of plumbing that makes it an increased risk to be an investor in. And those are all things that we take into account as we kind of put our buy box together on what we're interested in for apartments, for example. And last one here is condition. So talking about deferred maintenance, right? Things of the condition of the roof, the windows, the parking lot, the mechanicals, the occupancy, right? Current occupancy at the property versus market. We really like to also have an understanding of sort of what is the physical condition of any sort of property we're buying in, and what do we want to be careful to avoid, and what are we willing to take on from a risk standpoint. Just a few things to look out for as you guys as investors start looking out for properties or locations, right? On all property types, supply risk is huge, right? Understanding new supply coming into the market, understanding markets that may have some artificial limits to supply or maybe geographic limits to supply. But supply risk is something that we look at closely when we're analyzing a market, as well as governmental risk. I mentioned briefly political tilt. It can kind of go both ways, right? But certain municipalities have rent control. Certain municipalities, we've even found some that the tenants have the right to buy the building before you're even allowed to put it on the market. So those are all things we look at. Crime, as I mentioned earlier, on a demographic standpoint, how that impacts the location. For apartments specifically, we look a lot, and it's worth looking out for how strong the local schools are, as well as how healthy the average incomes are. Those are both things that drive demand, as well as a tenant's ability to pay their lease obligations. On the commercial side, we always look out for, again, the access, right? How challenging is it to get to the property? How challenging is it to get in and out of? That has a big impact on the leasability for commercial, as well as visibility, right? And that to a degree ties into access. Is just how visible is the property? How easy is it to find? How easy is it to get to? On the property side, right, for apartments, we look a lot at, again, the construction quality. Does it have outdated electrical breakers? Does it have flat roofs, which are historically expensive to replace and repair? Does it have outdated plumbing and piping that could cause long-term problems? Does it have old HVAC, outdated fire suppression? All of these are things that we check kind of in our first pass on any deal to make sure that we're aware of any sort of property deficiencies. On the commercial side as well, outdated sprinklers, it kind of falls in that same category, right? Limited truck court depth, low parking ratio, poor elevator or HVAC mechanical condition. All things that we look at on our first pass when we're looking at opportunities to make sure that we're getting ahead of potential challenges in the future.
And hey, quick question for you, Tim.
Yeah.
On these things that you've listed out right here, as far as things to look out for, what would you say is kind of the most often overlooked, or some stuff, at least in your experience, that you've seen become more of an issue and more of something that you give a little bit more weight to when analyzing an initial deal?
A great question. I would tell you in recent past, the supply risk side, I think, is probably the most overlooked. I think you're seeing that right now predominantly in some Sunbelt markets, but markets all over the place, is just being aware of the fact that sometimes supply outpaces demand. I would tell you what we're seeing in certain markets that are causing the most challenge right now is overlooking the supply. Now, on the property side, I would say it really is the deferred maintenance. I would say people tend to overlook on older properties or even newer properties, the amount of issues with HVAC, with roof quality, outdated sprinkler system, things like that. Those tend to be from deals that we see that people are not going through their due diligence with enough of a careful eye to pick out those deferred maintenance items.
Yeah, and I would wholly agree with you. I've seen some deals come across for clients where, people are trying to put them together, and the sprinkler and the fire stuff is really one that has seemed to be, at least in more recent years, been a little bit more of a problem. The fire codes a little bit, looking a little bit more at that older supply. I mean, that stuff can be just absolutely insanely expensive to bring up to code, depending on your municipality. So at least from kind of what I've seen on my side, that one has been a little bit more of a bigger surprise on things that can cause things not to pencil on the underwriting side.
Yeah, I think that's spot on. It definitely, I think a lot of people know enough to look out for roofs and to look out for HVAC, but you're very right that the fire suppression and fire alarms tend to be the most sort of non-updated items over time. And we have found some instances where, right, maybe a certain fire suppression system worked for one tenant in an industrial building, and then you get a new tenant and it turns out they need a different system. And so it's being aware of all of those systems and then what implications that have on your business plan and on your property.
Yeah, exactly. And also from the municipality side, some things that people don't realize can be grandfathered in under code, and depending on what certain changes or uses, like depending on the change of the actual building and build outs, will get a little bit more common in the commercial side or the industrial side, not necessarily always on the commercial occupied, like multifamily side, is just what things can trigger to have to do a full system update on stuff like that. So again, I'll leave it at that. It was just something kind of surprising that I've seen come up, more often now with people doing a lot more of the value add and reposition on older and less like less nice properties, if you will. It's not so much of a problem on like the B's to B pluses and the A minuses, but when you start trying to reposition those, DCs and low B's, a lot more needs to be done, and then you might trigger some of those, large build outs that otherwise might not necessarily have been a problem on stuff that was, kept up with a little bit better.
Yeah, no, those are all very, very good points to bring up. So continuing on from here, right, we've sort of talked through a little bit, again, the top-down approach of picking the right location or picking a location, right, not necessarily the right one, but how you think through location, how we think through property types, how we think through getting ahead of some of those risks that we might uncover later in the process. Once we've done all that and we've found an opportunity that both checks our box on location, checks our box on the property type that we like, it has sort of passed that sniff test on some of the supply risk, the access, the condition. It really then comes into how do you look at kind of a going forward business plan, right? How do you take a property from where you're at today, right? Because regardless of how much risk you're taking on a deal, anytime you're making an investment, the goal of that is to obviously A, it's to pay dividends to you, and B, is it to appreciate in time, over time, right? And so with that, we always try to find a way we always say 2 or 3 ways to make money, right? To kind of have plan A, B, C of how we're going to take the property and create value in it. So with that, I've kind of broken it down to the 2 main categories from a budget standpoint. Really, it's your income and your expenses, right, in a very simplistic way. And the first way that we begin analyzing these and to see if there's an opportunity there is to look at the history, right? It's how has this property performed in the past? I mentioned here, right, T12, right, that stands for trailing 12 months, right, the last 12 months of operations, but as well as how has it performed over the last 3 years? It's oftentimes important to not only look at the last 12 months, but to look at prior years to see, was this last year an outlier, right? Or is this year significantly worse than it's been in the past? And maybe that provides some more comfort in rebounding in the future. So we look a lot at those, at average rental income, what's the occupancy been, right? Other income charges like charging for pets or parking, or maybe charging for outdoor storage, something like that. And really asking ourselves, are these in line with expectations given the property in the market, right? Are the rental rates in line with other similar properties? Are they below? Are they above? And then with that, right, are there any opportunities here, right? Are there opportunities to increase rents, right? Maybe you're buying an industrial building where rent's $5 a square foot and all of the other properties in the market are renting for $8 a square foot. Or maybe it's an apartment building that's only 85% occupied, but everything else in the area is 95%. So we're looking at the historicals. We're saying, do these make sense given the property and the location? And what type of opportunities do we see to potentially improve the income? The one thing that I also note here that is something that we see that is a huge hurdle that we're conscientious of, is how long will it actually take to increase the revenue, right? Rents can certainly be below market, or occupancy can be below market, but the big thing is being realistic of how long is that going to take to actually turn things around. The number of times that we see opportunities sent to us where someone thinks that they're going to increase revenue by 25, 30% in the first 12 months, having done this now many times, we have not really seen that come to fruition, right? So it's not only do you project out what could happen in the future, but it's how long is it going to realistically take to do that. These are oftentimes big properties. It takes time. These are big businesses, right? It doesn't happen overnight. So that's one just kind of area that I like to point out that people should just be conscientious of. It's one thing to say there's an opportunity, and then there's another thing to say how long until we actually get there. And similar on the expense side, we always start with the historicals. We're looking at, right, historical, we call it the expense ratio. We talk about that in a little bit, right? Are there any specific expense categories that are too high, too low, or are not even contemplated at all? And how will these expenses change going forward? I'd say a really good example of this is a property that might be owned by an individual. Maybe they don't have a management fee, right? Maybe they don't pay a third-party manager to run the deal. Maybe they do the snow plowing themselves, and maybe they cut the grass, right? So, and maybe if you're buying this, or you're investing in an operator who's buying this, if they're going to bring in a third-party manager, if they're going to hire out a snow plowing contract, the expenses going forward are not going to be the same as the expenses in the past. And so we like to think a lot about how is it run currently? Is there anything that's going to change when we take over? And how will they change going forward? Taxes is probably the biggest one that we see, right? Knowing how the municipalities are going to reassess property taxes. We want to make sure in all of our underwriting that we're contemplating that. What's going to change on insurance? Insurance is a very big hot button issue right now with regards to how much insurance inflation there's been over the last few years. Payroll as well. How are the properties staffed? Who actually runs it? Is it understaffed? Is it overstaffed? And again, the management fee is obviously a big one too. Is who manages it currently? How are they compensated? How is that going to be different? These are just a few examples. We like to go through all of the main categories on expenses and really just make sure we understand why an operator or a sponsor is projecting a change either up or down in expenses, and make sure that aligns with what we think is going to be achievable. Now, in doing that as well, a big thing that we look at a lot is comparables, right? We say we're value investors, right? We're trying to buy something today that we think is a discount in today's market, and we're looking to bring that back up to what we think it should be valued at today. So with that, we're looking for a lot of comparables anytime we buy a deal, right? On the apartment side, these are just a few resources that we like to look at. It's a few of many, right? We'd like to look at CoStar. That's a huge industry resource, but it's an expensive subscription that mostly professional investors are using. But apartments.com is hugely valuable. Individual property websites, Facebook, Craigslist, and you can also look at professional industry reports too. Those are all vastly helpful to get a sense of what rents are other properties charging, what occupancy is typical in the market, right? If you're looking at something like an industry report, property websites and apartments.com are very helpful to understand what types of other fees are properties charging, whether it's pet rent or parking, things like that. So we look very closely at all of those sources to get a good understanding of how is our property comparing to other people, other properties in the area. On the commercial side, it's similar. LoopNet is a very, very helpful one to get a sense of lease rates. This shows what type of spaces are available on the market right now. CoStar, again, is very helpful, but that tends to be an expensive subscription. Crexi is another one that does a nice job showing what's available in the market. And we spend a lot of time talking with local brokers, calling up people who do leasing for some of the big brokerage firms. Very valuable data on what is realistic rents, what is good occupancy. And then again, professional industry reports is one that I think is super helpful, and that's accessible to anybody.
And just just to kind of piggyback on what you're saying right here is to demystify for some people, this is all great information coming from a little bit more of a lens of, what Tim is doing in the, from the institutional is not the correct word, but coming from the larger syndicator side, right? Again, there's a lot of variance. I know that doesn't fit exactly what they do to a T, but from the thing I also like people to take away from this, if you're an individual investor looking to come in and plug into someone's different deal, these are all great resources to check a prospectus against. It's all great to get the information from a provider, but especially when it comes to doing due diligence, keep in mind that what we're talking about here is stuff that you can utilize to kind of check whoever is providing the investment to say, hey, look, like, if you're calling them, if you're about to give them a bunch of capital, say, look, I've done my own research, here's what I came up with. Can you help clear up the discrepancy? And maybe it's something that you just didn't understand and there's some more context, or maybe it's something that would make you, take some pause and actually going that direction. So these are all great resources, not only for underwriting a deal, but also for doing your due diligence on syndicators and providers and operators as well.
Yep, exactly. And that's exactly what we're doing on a day-to-day basis is getting projections from somebody, and then it's our role in this, right, on behalf of our investors to, right, trust but verify, right, going through all of these different things and making sure that we have our own projections that kind of go alongside, and again, if we have concerns, that we can bring those up and make sure that they're factored into the deal. Right, so we talked a little bit about where to look. What to look for is obviously just as important, right? On the apartments, we're looking for to find properties in the same area, same vintage, similar size units, similar amenities and unit conditions, similar other additional fees and charges. It's good to just make sure you're looking at apples to apples when you guys are finding those comparables. On the commercial side, it's kind of a similar type of thing, right? Similar location, similar building features, right? Similar clear heights, similar loading, similar access, similar size suites, right? It's hard to compare an industrial building that's 100,000 square feet to one that's 1 million square feet, right? Those are going to command different lease rates. So you're really just trying to look for similar properties that offer a similar type of product to the end user. The other side of the budgeting as well that we really talk about thoroughly after we've sort of set income and expenses, and after we've really kind of verified the comparables, is looking at capital expenditures. We talked about this a little bit earlier on the deferred maintenance side, but we are very involved with any of our operating partners to set the upfront budget to make sure that we're budgeting properly to execute our business plan. I really break it into two main categories with sort of a third very important one. We call it kind of income producing and expense reducing, right? Income producing would be any sort of discretionary improvements that we're making with the goal of increasing revenue through either higher rents, higher occupancy, right? On an apartment building, that might be renovating the kitchens, that might be putting in new flooring and repainting units. In the common areas, that could be adding a fitness center or enhancing a dog park, or maybe sprucing up an outdated pool, right? These are all discretionary capital items that we think are going to make the property more desirable, more leasable, and command a higher rental rate. On the flip side is the expense reducing ones, which I think is often an overlooked category, right? So this is the deferred maintenance items. It's hard because it's hard to tie a dollar of savings to this. But at the end of the day, these are all items that buyers are generally very conscientious of when you turn around to sell it. But these are deferred maintenance items that are really cured to extend the useful life of a property and reduce ongoing maintenance costs, right? Things like redoing parking lots. These can be helpful if you're every year, if you're patching property, or if you're patching areas of the parking lot, if you redo everything once, hopefully that eliminates that ongoing expense. Same thing with roofs, windows, electrical and plumbing. We look very carefully into upgrading all of those so that we can, right, maybe you go and redo the electrical service and that might get you better insurance options. So you're able to reduce insurance, or maybe you proactively replace some plumbing and that eliminates damage coming from leaky pipes in the future. So those two categories are ones that we're looking at closely to make sure, given the property, given the vintage, given the condition, that we're really budgeting the expense reducing ones correctly, because these are ones that the last thing you want is to miss one of these categories, and all of a sudden 3 years in you realize that you need all new roofs and you didn't budget for it properly up front. So we look very closely at both of these, as well as we call it contingency planning, right? This is an additional budget for unexpected costs. I can absolutely guarantee that every deal has an unexpected cost that pops up somewhere along the way that was not contemplated originally. It's just part of the nature of investing in real estate. The biggest thing is to just have some contingency planning to be prepared for that. So we often aim to budget some percentage of the capital budget, right, the income producing budget, to make sure that we have some additional contingency in case things cost more. And then we also like to have a percentage of the operating costs. We like to put a budget up front of, right, maybe it's a year's worth of insurance, and maybe it's an installment worth of taxes and utility bills. Those are just good contingencies to have in case something ends up costing a little bit more, or you have an unexpected capital item that you hadn't budgeted.
Great. So just before we move on to the next slide, I had a couple of questions that had popped up. Just don't want to leave these people hanging for too long. But one came in, and I'm going to rephrase your question a little bit that you had asked with regard to rates of return. But is there any kind of resource out there that people can look at to get a general idea of specific property types with their yield rates for commercial property? Again, it varies widely, but is there any kind of resource where you can look maybe either geographically or by property type to what would be kind of a bad, good, better, best kind of rate of return on these things? Or is that kind of the thing that everyone's chasing, right? It's going to just vary widely, and there's really no specific resource for it.
It's a bad answer, but I would tell you it's probably something that there's not a great resource for it, and that makes it additionally challenging, right? At the end of the day, it's always hard to weigh risk and return, and because it varies so widely, that's I think why there's not a great resource, right? For you to buy an apartment deal that's 1970s vintage in a really small city in the middle of nowhere, it has a very different risk profile than to buy a 2010s vintage deal in a major metro market. They both might show an 18% IRR on paper, but the risk is just so widely varied. And so that's a big part of our job, is to figure out kind of where is that balance between risk and reward, and how do you make sure you're taking advantage of the opportunities where the reward is strong and maybe you feel confident that the risk is mitigated. I would say maybe the one resource that I really like, they come out with it, I think every 6 months, CBRE does a really good cap rate survey. That's probably the closest thing that I can think of that you can have access to. If you look up CBRE cap rate survey, you should be able to put in your email address and get access to it. It breaks out property type and regions, and basically shows a band of where properties trade at from a cap rate standpoint, based on market. It's not a perfect answer to your question, because that doesn't necessarily show kind of all-in returns, but cap rates are a really good way of just sort of comparing market by market, property type by property type. What type of unlevered return does an investor expect to get to be compensated for the risk of a market or a property type, if that makes sense?
Yeah, and again, that's a good answer on the CBRE report. But I would just add in too is that all this stuff is taking into account trailing data, right? When it comes to looking at what is going to, again, matriculate in the future, again, deals are being underwritten on, let's say a 4 or 5, typically year runoff for some type of event, whether that be a refi or reposition for sale. So again, it's difficult to kind of look at that from a research standpoint to get anything, and I don't also have any resources that I could chime in there as well, but that just be kind of the 2 cents that I add to that, is looking at data from a trailing versus a forecasting model, right? Because one, you have verified numbers and data that you can look at to produce things like average cap rates for property types in different markets. The other one being the one that you're going to look at before you invest, which is, again, the important part of it, because things can happen in markets. I live here in Florida. We just had 2 major hurricanes rip through here in the past, 150 days. It all depends. And then we had another kind of question / comment, kind of going back to, projecting the business plan and some potential issues, is that, localities of different properties can also weigh into things that you're looking at. He had also chimed in with the to the fire suppression stuff, but also how much kind of geographical issues do you also have to look at? The gentleman mentioned sandy soils being an issue for foundations. We also have that problem in Florida for our limestone shelf in certain areas being sinkhole prone. So is that how often does that come up, or do you just kind of bake that in and have like a general checklist for different areas of the US that you look at for maybe some region specific stuff?
Yeah, I think that it's a very, very good question, and it is a little bit of what you said, right? That comes a little bit more in what we would describe as sort of the due diligence phase, right? It's once we've gone through all of this and we've committed to investing in a deal, then it's really switching to the due diligence phase, and we spend a lot of time with our operating partner getting third-party reports, right? That's environmental, that's a survey, that's zoning reports, that's talking with the cities to understand municipal requirements, and a big one is the property condition report, right? So a lot of that stuff comes up in that due diligence process, and that does, to a degree, sort of like you mentioned, that changes a little bit based on what part of the country we're investing in, right? And it is something that you sort of broadly know what issues, whether that be construction or deferred maintenance, come up in certain regions that you might not find elsewhere. So it's less so in our underwriting process, right, when we're looking at the budgeting. And really, we try our best to get ahead of, right, when we first tour a property, do we notice signs of foundation problems, right? If that's the case, then we may try to build in an extra contingency in our underwriting for that. And then once we get into our due diligence phase, where we're expecting to get foundation reports, roof reports, HVAC reports, those are all the different things that we get on a deal by deal basis to make sure that we're not missing anything in our underwriting.
Great, awesome. That brings us up to date on the question. Just wanted to chime those in before we kind of moved on. People thought we forgot about them.
No, that is good to do. I will. I might pick up the pace on a few of these things here, just since we got the preferred equity half to get to as well still. And again, all of these slides are going to be made available, so feel free to go through them in a little bit more detail at your own leisure. So once we set really the capital budget, right, we've talked about, right, purchase price plus all of our other budget items. The biggest thing that we really get granular on as well is the capital stack, right? So the mixture of debt and the equity. In these deals, we're bringing the equity. So we spend a lot of time working with our partner to make sure we're putting the right loan on. So these are things that, again, this is how we approach it, but these are all things that as an investor, we like to make sure that we have a firm understanding on, so that we understand risks associated with debt. Right, leverage helps you get good returns when times are good, but it is a double-edged sword when times are challenging. So we're often borrowing from either a bank, a credit union, a government agency, right, Freddie, Fannie for apartments, life insurance companies. We don't do as much debt fund borrowing. That's never really been a key lending source for us, but they're all available out there, and every operator has their different preferences. So each one has their own benefits and drawbacks, right? They have different rates, different loan terms, right? Different recourse, right? Guarantees to repay the loan, and they give different leverage, right? Different percentage of the capital stack for debt. I would say it's key to understand why someone would borrow from each respective lender. So when you're looking at a deal, understand who is the lender, right? Why are they the lender that's right for this deal? Some key terms that I always say are worth understanding, right? Loan term, how long until the loan matures, right? Is it a 2-year loan with some extension options, or is it a 5, 7, 10-year loan? We always like to try to match our loan term or have our loan term exceed whatever our underwritten business plan is. And that's just to have some risk of having to refinance the deal in the middle. Interest rate type is one we look at a lot, whether it's fixed or floating. Right, that obviously is a big kind of hot button issue in today's world when interest rates have gone up so much. Right, is your rate subject to movements in interest rates? Interest only period, we look at that a lot. How long until a loan begins to amortize or pay principal down? That's something that you see a lot, probably more with apartments than commercial. And then recourse, is there a personal guarantee on the loan? That I think is a very good alignment of interests when an operator is taking a loan with a personal guarantee. We've seen a lot of deals that have come through. This tends to be a little bit more in the debt fund space where it's a very high leverage loan, but the debt fund is not expecting a personal guarantee, and so therefore there's really nothing on the hook for the operator if something goes sideways. So these are all considerations on the debt terms, but there's other things to think about as well, right? There's the senior debt, but there's also secondary, right? These could be more proceeds from the senior lender. These could be a different lender. It can be used to increase leverage if people are looking for more debt, but it can also fund future capital projects, right? If you're going to go and maybe you're going to replace all the roofs, maybe your lender's going to put an extra $1 million of loan proceeds in a reserve account that you can access if you need to replace the roof. Big things to understand here, again, loan terms, right? Same things as on the senior debt, but it's worth understanding if they're going to be the same or if they're different. And the other thing here too is what is the leverage point once the loan is fully drawn? You might have a loan that maybe it's a fine leverage point when you buy it, but if there's a huge line of credit to draw loan proceeds later, the leverage point might at some point get a little higher than you're comfortable with. So those are all things to just be aware of. And then again, there's other debt and debt alternatives, PACE financing, which is to finance green energy improvements, mezzanine debt, right, which kind of comes between senior debt and equity, or preferred equity, which we'll talk about in a little bit. It's key to understand who your lenders are, what their terms are, how much leverage are they providing, right, and what does this extra leverage do to the IRR and the cash flow, right? A lot of times people use leverage to make the returns look better, and so it's good to be conscientious of why they're using the leverage that they're using and what impact does that have on the deal. The last part that I want to hit here on kind of the verifying the key assumption side is really projecting sales. This is one, again, that is probably one of the biggest impacts on returns. And so just talking through this quickly is just key to always be asking this question anytime you're looking at deals, right? So just from an equation standpoint, right? Your sales price is your net operating income at the time of sale divided by whatever exit cap rate an operator is using at that time, right? At the end of the day, you can project whatever you want, but your exit cap rate is dictated by whatever the market is at that moment in time. So you're best to try to find an exit cap rate that you believe reflects what the market's going to look like in 3, 5, 7, 10 years, and to use that. So those are really the key 3 inputs, right? Year of sale, which would be your hold period. It's your exit cap rate, like we talked about, and then it's whatever your projected net income is at that time. For the year of sale, it's not talked about as much, but it has a material impact on your projected returns. It's good to analyze all of your investments assuming the same time horizon. For instance, we look at everything on a 5-year hold period. Again, it's comparing things that are apples to apples. If you have a 3-year projected deal and a 7-year projected deal, the returns are going to look very different. But again, it's hard to really look at those on a comparable scale. Exit cap rate, I say this is often the most impactful assumption and most challenging to quantify in any underwriting. We like to say a good rule of thumb, and it's strictly a rule of thumb, is for your exit cap rate to be around 100 basis points higher than the cap rate that you bought your property at. Some operators believe the cap rates are going to go down. Everybody has their own justification to the cap rate that they're using. What's important is that you are comfortable with whatever exit assumption is that's being used in a deal that you're investing in. They're very, very nuanced, right? Cap rates are location specific, property specific, property type specific, property feature specific. And so this is the one assumption that I really like to drive into any deal that we do and any deal that's pitched to us to understand why they're using the assumption that they are. The last one here, which is not as big of one, but it's one to be aware of, is the net operating income, right? This can either be the year of sale, or some people will use a forward year, right? If they're selling in year 5, they might use the income from year 6. That's just something to be conscientious of their method of what NOI they're using. Here's just a few different key metrics ratios that we look at that kind of sum all of this up. So expense ratio, it's what share of expense, like operating expenses is a percentage of net income. We look a lot at 5-year NOI growth, right? How much is your income changing between year 1 and year 5? Exit cap rates, again, operating income divided by sale price. It's based on different property types, but this is, in our opinion, one of the most key assumptions of any deal. On the leverage and the loan side, we look a lot at the debt service coverage ratio, right? This is basically, it's your income, net operating income divided by your debt service, right? We like to be sure to include amortization. A lot of times people will use it based on an interest only, where you don't have to actually pay your amortization. Lenders try to have an amortizing 1.25 times debt service coverage ratio, meaning that your net operating income is 125% of your annual debt service. This is just a good rule of thumb to make sure that if your net operating income fluctuates a little bit, you can always cover your debt. And the last one here, again, this is different for every investor and every investment type, is your loan to cost. It's your loan amount divided by the total cost of the deal. We try as much as we can to keep that around 65%. We believe it's prudent to keep it below 70. But just being aware of what that is on your deal is important for you to know as an investor. So that sort of wraps up at least kind of our underwriting process, right? It's finding the right location, finding the right property, it's projecting out the income and expenses, finding comparables, projecting out the capital stack, the budget, projecting out the debt, and making sure we're aware of all of those different terms along the way. That's at least our process. There's a million ways you can go about it. But those are just some considerations that we like to think about as we approach investing and things like that. Now, the second half of this, which I know we're well beyond the second half, is to just get into a preferred equity a little bit and what that is. It's something that like I said, is not as prevalent 5-10 years ago, but especially today in today's market as rates have run, preferred equity is becoming a little bit more interesting. So as you can see on the graphic on the right side, preferred equity is a part of the capital stack that comes above the senior debt, but that comes in a preferred position to common equity, hence the name preferred equity. So I bolded kind of a more formal definition, right? It's ownership interest of an asset that is a priority position to common equity investors. That can be priority to distributable cash flow, right? You get paid a dividend first, priority at the time of equity repayment, right, in a sale or refinance. And it has limited upside oftentimes in comparison to common equity. But again, you trade off that upside for having a priority in repayment. Again, I say all of this it can be because preferred equity comes in many, many shapes and sizes. It's very important to understand the legal structure and the terms of the preferred equity when making an investment in that space. Really quick, just hitting the components of it, and some of this may be redundant to some of you and some of it may be new, but preferred equity is often broken into kind of two parts that equal the third, right? It's a current pay, right? You've got a preferred distribution that gets paid before the common equity, but after the senior debt. And then you oftentimes have an accrued amount, which would be an amount that gets paid later, right? And those together create sort of the total return, which would represent basically an annualized IRR for the investor. So oftentimes you'll hear something like a preferred rate of return at a 14%, right? Over the course of your hold period, you'll receive a 14 IRR. 8% of that is quote unquote current pay, where it's paid, could be monthly, quarterly, semi-annually, annually. It's paid out as a dividend. The remaining 6% is not paid on an annual basis, but at the time of a sale or a refinance, the accrual is paid out so that your total return equals that 14%. So those are just the kind of, from a definition standpoint, those components. Just a few different differences, right, between preferred equity and common. Preferred equity is, or maybe even start on the right, common equity is the highest risk in the capital stack, usually between 75 and 100% of all capital at risk. Preferred equity, it comes next in the capital stack. It's the second highest portion at risk. Usually is somewhere between, call it 65 and 75%, sometimes a little higher. Preferred equity gets paid after the debt service, but before the common. And common equity gets paid last, but they retain all of the cash flow and appreciation once all other parts of the capital stack are paid back. Typically, Preferred equity does not receive any of the tax benefits. That is one drawback. Right, I know a lot of people invest in real estate to get some of the tax benefits. Preferred equity is often treated as ordinary income and taxed accordingly, where common equity often receives a pass-through of the tax benefits and then is taxed at a combination of ordinary income for distributions and capital gains for appreciation. When you put it on paper, right, the common equity seems like it's more lucrative because you've got the upside and you've got the tax benefits. But a huge benefit of preferred equity is it reduces your risk, right? And that's a broad statement that's not necessarily always true, but it puts you in a more protected position than you would be as a common equity investor, right? We try to eliminate as much of the risk as we can or mitigate as much as we can in that kind of top-down approach we talked earlier. But there are instances where the preferred equity puts you in a more safe position or a reduced risk position than what you'd see from a common standpoint. This is a little bit wordy here, but I'll kind of run through a good example. There's a property that you bought for $25 million. You've got a $15 million loan, $5 million of preferred equity, and $5 million of common equity. Over your hold period, say that your investment accrues, your preferred equity accrues $2 million of interest, right? So your preferred equity, instead of being owed $5 million back, you're owed $7 million. Say the market takes a turn and the property sells for $22 million, right? So it's worth $3 million less than what you paid for it. The lender still is going to get their $15 million. You get your $5 million of your preferred equity back. You also get $2 million of accrued interest that's owed to you. So you get your full investment back and you get your return, but there's no money left for the common equity investors. They've lost everything, unfortunately, in this scenario, right? You may have capped your upside if things went well, but by being in that preferred position, as things don't go according to plan, you still have a buffer before you start being at risk of losing money, right? Capped upside, it goes both ways, right? So if the same scenario, right, a $25 million property with a $15 million loan, $5 million of preferred and $5 million of common, right, your position accrues to $7 million, but if the property sells for $32 million or $7 million more than what it was sold or purchased for, the lender gets their $15 million, you get your $5 million, you get your $2 million of accrued interest, and the remainder of that $10 million goes all back to the common equity investors, right? You've capped your upside, right? Maybe that was an opportunity that you should have been in the common, but at the same time too, you protected yourself in the event that things went the other direction. So you protected your downside if that underperformed, but in an instance like this, all of the appreciation goes back to the common equity investors. This is just a few different opportunities of where you can use preferred equity. Some of those sort of apply to the market that we're living in today, which I think is sort of valuable, right? It's when the market has increased risk, right? As market uncertainty increases, it could be a good way or reason to explore preferred equity, to stay invested in the market, but to maybe try to protect your downside a little bit more. Another big one is right when rates of return become compelling. Market rates for preferred equity are constantly changing. 5 years ago, you'd be lucky to get an 8 or 9% return. Today, you might be able to get a 14, 15% return, right? And so at some point, as rates move and preferred equity all of a sudden becomes attractive, if your long-term goal for investing is to generate an 11 to 13% return, you might be able to hit that by being in a preferred equity position. I would also say that the other big opportunity is when your main priority is cash flow over appreciation, right? We talked about capping upside, but you get paid distributions first in many instances. So if you prefer cash flow over appreciation, this can be good because you might be able to earn a distribution higher than what you could get on common equity, though you're giving up some of that upside if the deal performs very well. This is just some drawbacks, right? I mean, every investment comes with its benefits and drawbacks. Preferred equity is not as tax efficient. As noted earlier, preferred equity is taxed at ordinary income and does not often get allocated losses. There's less control of the deal, right? Oftentimes, if you're a preferred equity investor, it tends to be a more passive position than if you are the common equity investor. Shorter hold periods. Preferred equity is usually used to sort of fill a gap, whether it's to create some shorter term higher leverage, maybe it's to supplement leverage, maybe it's to fund a capital improvement project. But typically speaking, they often get repaid every 1 to 3 years, meaning that if you're looking for long-term cash flow, you may need to continuously find new opportunities. The last here is availability of opportunities, right? Not every deal has preferred equity, and honestly, most don't. And so the number of available opportunities is significantly less than common equity opportunities. So you just need to be aware that there might not always be those opportunities out there. Things to look out for, right? It's always worth asking, why does this deal need pref? Right? Is it challenging to finance? Is it underperforming? Do they need more leverage to hit their IRR? Right? Can the property support the current pay? We talked about the debt service coverage ratio, right? It's same goes to the pref, right? They could tell you that you're going to be paid 8% per year, but does the property actually make enough cash flow to pay that? What are the rights? Does the operator have to pay you the current distribution, or can they stop doing that, right? And what happens if they do? Like I said, every deal is structured differently, so make sure you understand what is the order that everybody actually gets paid back in. Right? Could the pref investor call for a sale, right? Do you have any rights to ask or to force the operator to sell the property? And the other big one too is, what's the leverage point, right? How high in the capital stack are you going with your preferred equity investment? How much common equity is actually left in the deal, right? Again, it's all making sure that the incentives are aligned correctly. If you, at a certain point, if you're going too high in the capital stack, you're still taking on more risk than maybe it's worth to have your upside reduced. I figured I would just at the end of this kind of leave with one good example of where we at Midloch have used preferred equity. We were presented with an opportunity to invest in a target anchored retail center as a common equity investor. It was a really nice kind of newer vintage deal, good tenants and a good cap rate. But after underwriting the deal, right, everything that we talked about earlier with setting the budget, the income and the expenses, we thought the returns were just not quite strong enough as a common equity investor to invest in the deal. So we had declined it originally. But 1 month before the acquisition, the operator who asked us to invest, their lender reduced their loan proceeds by $2 million. And they were left with a pretty big hole to figure out with not a lot of time, and asked if we would be interested in revisiting the deal. Right? Given that we declined previously, we knew the deal well and liked the opportunity. The returns were just a little thin. So we offered to provide preferred equity for that $2 million to sort of fill the hole in their capital stack. In that instance, we received an 8% current pay, which is paid out quarterly, and an additional 7% accrues, so that we get an all-in return of 15% per year. Right, again, like the last point, our position in the deal is at about 68% loan to cost. We took the leverage from about 63 to 68. We thought that was a really good leverage point, and there was over $10 million of common equity that was in a first loss position. So the common equity had to lose $10 million of value before our position was at risk of deteriorating at all. So this is a good example of kind of a real life scenario where preferred equity fits in, and where we viewed it as being an attractive alternative to being a common equity investor. I know we're at the top of the hour, and many of you might have to jump. So I wanted to make sure we had at least a little bit of a time for questions. I threw a lot out there. So I don't know, Alex, if there's anything else that's kind of come in while going through, or if there's anything on the preferred equity side that you want to revisit.
No, I mean, I think you covered it pretty well. It's it's a topic I've also just kind of been putting into my lexicon from investors in recent months, because again, just with shifting markets, the availability and the need for preferred equity, especially in a dynamic interest rate market like we're going through, is creating new opportunities. That's one thing that one of the reasons why I wanted to have you on here today. One, your wealth of knowledge on the underwriting side is top notch, but to kind of bring a example of, just because everyone is saying, getting all shaky about interest rates and the cap rate compression and just how hard deals are to pencil now, doesn't mean that there's not opportunities. When one thing becomes more difficult, something arises to be able to capitalize on that. So again, that's, in your own words, I think you nailed it right on the head. And again, now's the time for anyone that has questions. I would like to pepper them in. Go ahead and address those. We have one question coming in. When placing preferred equity in distressed deals, how does that change the metric of the deal? And I think that's a very broad question, but just to some high points, like what are some of the key things that it just inherently is changing when coming in from a preferred equity viewpoint for a deal?
Yeah, it's a good question. I think the biggest thing that we're really looking at, right, is what is our downside, right? Especially when we're being conscientious of how much common equity is in the deal, right? How much income is it producing? Especially a distressed deal. I'd say that our metrics change a lot less on focusing on, right, how far can we take this business plan to make the property worth more? And it really comes, what is the current income? Can that current income support our current distribution owed to us in the pref? And then is there an ability down the road to sell this for our last dollar of risk? Now, I would add to that that the biggest consideration that we try to make right now that I would give a word of caution to investors on is a lot of people are trying to put preferred equity on their deals to basically supplement a capital call, right, on a deal that's not going well. It's worth being careful to understand, right, what is the true value of the deal? Is there any equity left in the deal if the property has gone down in value? Right, there's one thing to say that, hey, originally someone invested 40 million and we need preferred equity up to 35 million. But if the property is only worth 35 million now, there is no equity left in the deal and you're at basically 100% leverage in your preferred equity position. So I would say we really focus a lot on what is the true value of the deal today, right? How much cash flow does it produce and can it actually provide us enough cash flow? And then the big thing is if the deal's not worth what the last person paid for it, what is their incentive to keep spending the time to try to get the deal back above water? Because there's a lot of these deals right now that I think have gone a little sideways. We like to make sure that there's an appropriate alignment of incentives for the operator that we're investing with to spend the time and the energy to get the deal back on track, if that makes sense.
Yeah, again, is the juice worth the squeeze? If you put in all the effort, time, and capital into it, is it going to be something that's, are you doing all of this to net a 3% return?
Yep.
It's doubtful, right? We had another question, and I think we covered this pretty well, but again, just bears a little bit more explanation. Is there ever a benefit or framework to consider a JV versus a preferred equity structure? And again, that's kind of what we covered, or what Tim covered on specifically why you would go that direction. But maybe just at a high level, if you're looking at apples to apples in a deal, what would make something much more appealing for the JV investor versus a preferred equity play? Like, what are some, again, the key things that would trigger saying, okay, this is definitely the route we should explore for this versus the latter?
Yeah, no, it's a good question. I'd say first and foremost, the preferred equity is tricky because not everybody wants preferred equity in their deal, right? If they're looking for JV equity, not everybody would be open to preferred equity. So there might not even be an opportunity to decide between the two, I guess I would say as a word of caution. Right, when we're bringing in a large investment, so oftentimes they may be a little bit more open to that if they're not originally advertising for it. But I would say that the reason that we've sort of pivoted to it are instances where we've preferred the preferred over the common or the JV equity is in instances where we really like the real estate, we like the market, but we don't know, to Alex's point, if the juice is worth the squeeze on the common equity. Right? Maybe the operator thinks it's going to be a 20 IRR, but we think it's going to be an 11, right? That's all hypothetical. That really just kind of comes down to our underwriting. There might be instances where we say, hey, we still like the deal. We think there's a good path to make money, but we think it's only an 11 IRR. But if they're looking for preferred equity to kind of fill a gap in their capital stack and they're willing to pay a 14% all-in return to the pref, those are instances where we maybe explore that when we really like the real estate, but we just think in today's market, the returns just aren't there. We've sort of taken the approach of anytime that we do preferred equity investments or make preferred equity investments, it's in deals that we like with operators that we like, where we believe that there is still a path forward to make money. We're very cautious about getting into preferred equity investments in hyper distressed deals where operators might not be incentivized to participate much in the future. But I guess I say all of that we look at everything through the lens of JV equity first, right? That's our core business. We now that preferred equity rates are attractive, we use that as just sort of a toggle of if a JV equity investment is a good opportunity, but we still want to participate in a protected position, that's when we make that pivot. Otherwise, if we like the upside, we believe in the business plan, we think the rents are strong, we think there's an ability to push occupancy, our preference is always to be able to participate in that upside. But especially as rates run, or as rates have run, and the market gets a little soft, it gets to be a threshold where if the common equity we think is a 15 IRR and they're willing to take preferred equity for a 15% return, we'd rather be in a protected position in that scenario, if that makes sense.
No, great answer. Let's see, where's my mouse? There we go. So what would you say is the primary difference between preferred equity and a promissory note?
I would say the biggest thing is really in the rights, right? It's what control provisions do you have, to a degree that, so a promissory note can come in obviously a variety of different forms, right? That could be your senior debt, your secondary. I'd say maybe the other way to frame that, just from an investor perspective, is the difference between preferred equity and mezzanine financing. And that really just comes down to, again, the rights, right? Is it structured as debt or is it structured as equity? When you're doing something like mezzanine financing, it is an instrument structured as debt, which basically means you as a mezzanine lender would have a right to foreclose, no different than a bank would have the right to foreclose if you don't meet the loan covenants. As a preferred equity investor, you are just that. You are equity, but you come in a preferred position that's outlined in the operating agreement. So you don't really have the rights if things go sideways to foreclose on the deal as you would if it was a promissory note. So as a real estate operator, many times they would much prefer for you to be preferred equity because it mechanically works similarly, but it comes with reduced rights and remedies to something that would be a promissory note.
Good, great question. Let's see, next question. Can you offer a pro-con review of a sponsor creating their own debt fund versus a third-party pref equity offering?
Oh boy. It's so situational. I'd say the biggest thing, so there's benefits and drawbacks again, right? In a preferred equity offering versus a debt fund offering, right? In a debt fund, typically speaking, I would tell you the returns would likely be a little bit lower, but you'd have more rights and remedies, right? You have an ability to foreclose, an ability to force a sale, and the legal process to do so is much smoother than preferred equity. The preferred equity front, again, it's going to be something where you have fewer rights, but hopefully the returns compensate you for that. The biggest thing that I would say to be very careful about in today's world is just what is that money actually going for? We're seeing a lot of instances, I shouldn't say a lot, but we've seen some instances where groups are raising preferred equity under the guise of, right, a new preferred equity fund, but it's really to create a means of bailing out deals that are not going according to plan. Again, that's not necessarily something that's happening broadly, but it's certainly something to think about. So I would say anytime that you see, right, a sponsor raising their own internal either debt or preferred equity fund, it's just worth the question of and the further diligence as they go through it of what is that actually being used for? Is it being used as a means of rescue capital to save your own internal deals? Or is this a sponsor who's able to go out and provide preferred equity or debt to other groups that are in need of it? It's a nuance that I would say is just, it's worth knowing as you start analyzing those.
Yeah, absolutely, and it bears some, some more difficult or more pointed questions, I would say. If you have a deal sponsor that's going that direction, asking, the hard whys and the reason behind it, and additional verification. And it may not necessarily mean that the deal is completely belly up, but it's again, there's a reason that they're coming out and needing more capital, whether it be from a debt structure or a self-funded debt structure or a pref equity offering.
Exactly.
But again, just it's when doing due diligence, it's just another thing to consider and make sure you ask the proper questions. The last question that's posted here, I would just defer you to ask Tim directly. It has to do with some specific deal questions on things that might have gone south. The only reason I ask those kind of questions to be asked directly is these webinars live on in perpetuity. So there might be something that is a little bit more deal specific that is better just to have that conversation personally. So again, if you do have questions specific to that on performances of things that Midloch has actually gone through, Tim's information is right here up on the middle of this for you. Tim at Midloch, midloch.com. Excuse me. Or 414-795-5849. Just reach out to them directly. Tim will be happy to kind of go through that with you. And with that, there don't seem to be any more questions, so we can go ahead and kind of end this off here. Again, if you do have any questions for Tim, I'll go back. His information is right there. If you would like more information on how to do these kind of things through an IRA, again, I'm your guy. Love to help you out with that. Directly 727-754-9954 for myself over at Advanta. Again, Tim, thank you so much for being on with us today. It's been a wealth of information. Great questions, everyone that was tuning in today. If you want to grab a copy of the slides, you can grab them as a handout right here, or Tim and I both also have them, so you can reach out and we can provide those as well. Any last parting thoughts before we let you go, Tim?
Nothing too pointed. I appreciate you guys having me on, and it's obviously a challenging and kind of turbulent time in the market, but there's always really good opportunities. It's just about, to what Alex said, it's asking the why and being diligent as you go through investing. There's always new things to look at, and it's really exciting to get into the alternative space. So hopefully this was helpful as you go through your deal underwriting process, and I'm more than happy to provide some other insights from what we've learned over our careers.
Fantastic. Well, again, thank you very much, Tim. Thanks everyone for joining, and we'll see you on the next webinar. Bye now.